Every single day, trillions of dollars change hands in the stock market. But what actually happens when you click that buy button? And why do stock prices constantly go up and down? Today, we're breaking down exactly how the stock market works, from complete beginner to confident investor. Let's start with the basics. What exactly is a stock? When you buy a stock, you're buying a tiny piece of a company. You become a part owner. If the company has 1 million shares and you own one, you own 1/1,000,000th of that business. Companies sell stocks to raise money. Instead of borrowing from banks and paying interest, they sell ownership pieces to investors like you and me. This is called going public, or an IPO, initial public offering. The company gets cash to grow and investors get a chance to profit if the company succeeds. Now, here's where it gets interesting. Once those shares exist, people can trade them with each other. This is where stock exchanges come in. Think of them as giant marketplaces where buyers and sellers meet. The New York Stock Exchange, the NYSE, is the biggest in the world. You've probably seen images of that famous trading floor with people shouting and waving papers. NASDAQ is the other major exchange. It's fully electronic, no trading floor needed. Most tech companies trade here: Apple, Microsoft, Amazon. But how do stock prices actually get determined? It all comes down to supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price drops. Imagine a popular concert, limited tickets, huge demand. Prices skyrocket. A boring show nobody wants to see. Tickets go for cheap. Stocks work the same way. Good news about a company creates buying demand. Bad news triggers selling. Prices adjust in real time, second by second. Every stock has two prices you need to know. The bid price is what buyers are willing to pay. The ask price is what sellers want to receive. The difference between them is called the spread. When you buy, you pay the ask. When you sell, you get the bid. And this tiny gap is how market makers earn their profit. Now let's talk about different types of stocks. Common stock is what most people buy. You get voting rights at shareholder meetings and potential dividends, which are portions of company profits paid to owners. Preferred stock is different. So you get paid dividends first before common stockholders, but you typically give up voting rights. And there's the growth versus value distinction. Growth stocks are companies expected to expand rapidly. Think young tech companies. They rarely pay dividends, reinvesting everything into growth. Value stocks are established companies trading below what analysts think they're worth. They often pay steady dividends. Think banks, utilities, consumer goods companies. Blue chip stocks are the giants, household names with decades of reliable performance. Coca-Cola, Johnson & Johnson, Procter & Gamble. Lower risk, but also lower potential returns. You've probably heard about market indices, the Dow Jones, S&P 500, NASDAQ composite. What are these exactly? An index tracks a group of stocks to measure overall market performance. Instead of watching thousands of individual stocks, you watch one number. The Dow Jones Industrial Average tracks just 30 large companies. It's the oldest major index, started in 1896. The S&P 500 follows 500 large companies, giving a much broader view of the market. When people say the market is up or down, they usually mean the S&P 500. And the NASDAQ composite tracks everything on the NASDAQ exchange, over 3,000 stocks. It's heavily weighted toward technology. And when the index goes up, it means most stocks in that group gained value. the market's having a good day. Now let's talk about bulls and bears. No, not the animals. Market cycles. A bull market means prices are rising and optimism is high. Investors are confident, buying more, pushing prices higher. A bear market is the opposite. Prices fall 20% or more from recent highs. Fear dominates. People sell, pushing prices even lower. And these cycles are natural and inevitable. Markets go through periods of growth and contraction. Understanding this helps you avoid panic selling at the worst times. Here's a key insight. Time in the market beats timing the market. Trying to predict tops and bottoms is nearly impossible. Staying invested through cycles historically produces better results. So how do you actually buy stocks? You need a brokerage account. Think of it like a bank account, but for investments. Fidelity, Charles Schwab, TD Ameritrade are traditional options. Apps like Robinhood, Webull, and SoFi made investing more accessible. Many offer commission-free trading and no minimum deposits. Once your account is funded, buying is simple. Search for a stock by its ticker symbol, enter how many shares you want, and execute the order. Market orders, buy immediately at the current price. Limit orders only execute if the price hits your target. For beginners, I recommend starting with index funds or ETFs, exchange traded funds. Hold many stocks in one package. An S&P 500 ETF gives you instant diversification across 500 companies. One purchase, broad market exposure. Warren Buffett himself recommends this approach for most investors. Diversification is crucial. Never put all your eggs in one basket. Spread investments across different companies, industries, and asset types. If one stock crashes, others might hold steady or rise. Your overall portfolio stays more stable. Let's talk about common mistakes to avoid. First, emotional trading. Fear and greed destroy portfolios. People buy when prices are high because everyone else is, and then panic sell when prices drop, right? This is backwards. Ideally, you want to buy low and sell high. Emotional reactions make you do the opposite. Second, not doing research, buying stocks because someone on social media said, so is gambling, not investing. Understand what you own and why. Third, trying to get rich quick. Day trading and meme stocks might seem exciting, but most people lose money. Consistent, boring investing builds real wealth over time. Fourth, ignoring fees. High expense ratios on funds eat into your returns. A 1% fee might seem small, but over decades, it can cost you hundreds of thousands of dollars. Fifth, not having a plan. Know your goals, timeline, and risk tolerance before investing. Are you saving for retirement in 30 years or a house down payment in 5? Now, for getting started, here's my recommended approach for beginners. First, build an emergency fund. 3 to 6 months of expenses in cash. Never invest money you might need soon. Second, take advantage of employer matching. If your job offers a 401k match, that's free money. Contribute enough to get the full match. Third, open a Roth IRA if eligible. Contributions grow tax-free, and withdrawals in retirement are tax-free too. Fourth, start with index funds. Low cost, diversified, and historically proven. The S&P 500 has averaged about 10% annually over the long term. Fifth, invest consistently, set up automatic contributions. So time in the market matters more than timing the market. Sixth, keep learning. Read books, follow reputable financial news, understand what you own. Knowledge compounds just like interest. The stock market can seem intimidating at first. All those numbers, charts, and jargon, but at its core, it's simply people buying and selling ownership pieces of companies. right? Supply and demand determining prices. Businesses growing and sharing profits with owners. You don't need to be a financial genius to invest successfully. You need patience, diversification, and a long-term perspective. Start small if needed. Even small, regular investments grow significantly over time thanks to compound returns. The best time to start investing was yesterday. The second best time is today. Take what you've learned, open that brokerage account, and begin building your financial future. The market will have ups and downs, that's guaranteed. But historically, patient investors who stayed the course have been rewarded. Your future self will thank you for starting now,